It's been 4.5 years since the Federal Reserve launched the first quantitative easing program. According to the CNBC Fed survey, QE will continue well into 2014. I spoke with Peter Schiff, CEO of Euro-Pacific Capital, about how long interest rates can remain low and facilitate current U.S. deficit spending. Given the president's announcement today about the possibility of chemical weapons in Syria, I first asked if spending, either military or domestic, must be severely curtailed.
This is the guns and butter argument. Right now, we think we can have both. And as long as we can borrow money at practically 0% interest, we can pretend that we can have both. But eventually, interest rates are going to rise, and the government's going to be forced to make some difficult choices. There's going to have to be a lot of cutting going on. I think we're going to have to cut in both military and domestic, because we're not going to be able to afford a lot of these expenditures.
Well, do you think it's possible to reduce the debt and the deficit while the Fed enables lower interest rates vis-a-vis quantitative easing?
Well, no, I don't think anything is going to be accomplished constructively as long as the Fed is spiking the punch bowl. I think a prerequisite to a legitimate recovery is going to be sound money and higher interest rates, right? We're going to have to sober up. We're going to have to check into monetary rehab. We can't keep drinking and expect to solve these problems.
Well, I have here a graph of the federal funds rate since the 1950s. We're clearly in a long period of extreme easing stretching back to 2008. Now the Fed has hinted at its exit strategy of winding down large-scale asset purchases. But I've heard you say that Bernanke doesn't actually have an exit strategy. Bernanke's famous or infamous for saying he can reverse monetary policy and stem price inflation in 15 minutes. So do you not believe him?
Now, well, at best, that's wishful thinking, but it's not going to happen. You cannot reverse this monetary policy without imploding the economy that is based on a continuation of that cheap money. We have created an economy that is completely dependent, addicted to 0% interest rates and endless quantitative easing. If the Fed takes that away, the economy will implode. But they can't admit that. They can't acknowledge that. So they have to talk tough, right? They have to bark a lot, but they can't bite because they have no teeth.
Well, what about Bernanke's toolkit? He has the term deposit facility, tri-party reverse repos, and the Fed could always sell assets if it was backed against a wall. You really don't think any of these are going to work?
Sell the assets to who? Who's going to buy them, and at what price? You know, when the Fed tries to unload all these mortgages and U.S. Treasuries, there are no buyers. The Fed is the buyer. And the only reason other people are buying is because they think the Fed is going to keep doing it.
Based on the last minutes of the Federal Open Market Committee and speeches by various Fed officials, I think it's possible we might see short-term interest rates rise towards the end of this year. What do you think are going to be the net effects of that?
Well, as I said, the economy can't handle it for a number of reasons. The banking system can't handle a big increase in rates. The mortgage market, the housing market, can't handle an increase in mortgage rates. The U.S. government can't handle an increase in interest rates because it doesn't have the money to make the payments. I mean, look at all the pain that we have because of the sequester, which were tiny, tiny reductions in the rate of increase in government spending. Can you imagine if short-term interest rates rose just a little bit and the government needed an extra $100 billion or $200 or $300 billion a year just to pay the added interest on the national debt? I mean, that'd be a real disaster. That's going to happen eventually, but I don't think there's any way the Fed is just going to allow that to happen if it thinks it can postpone the pain by printing more money, which I think is what we're going to do. So I think what we'll see first is weakness in the U.S. dollar against other currencies. You'll see a breakdown in the dollar index and a bigger increase in the price of gold, a big reversal of the recent weakness we've seen in gold. I think you'll see the dollar break before we see the bond market break, because the Fed will print all the money they have to prop up the dollar. But I think the break in the bond market will eventually force the Fed's hand, and it will not enable them to continue to prop up the bond market. And then we're going to have to deal with this problem.
Well, one of the arguments for higher interest rates is that it'll help savers, especially retirees who are earning very low returns on bonds and who have been forced into riskier assets just to receive higher rates. You don't think this is a good policy?
No, it is a good policy. We need higher rates. The problem is the economy right now can't afford higher rates given the enormity of the debt. So what's going to happen when interest rates go up is a lot of the debts are going to go into default. We're going to have to restructure the economy. But you're 100% right. Before we can have a real recovery, we're going to have real interest rates. We're going to have an increase in interest rates that encourage savings, reward savings, that discourage profligate consumer borrowing, government borrowing, so that our credit can be available to businesses to make the capital investments that we need to expand our productive capacity, to hire people in real jobs, and to grow our standard of living.
Well, how do we wean our economy off all of this federal support?
I don't think we can wean it off it. We got to go cold turkey. But unfortunately, nobody wants to do that. Everybody wants to pretend that we can just keep on doing exactly what we did to create the crisis, and somehow that's going to magically solve the problem.
Do you think the U.S. can continue to hold the world reserve currency status?
No, not if we continue on this course. I think the dollar is going to lose that status. What's going to replace it? I don't know. I don't think it's going to be another currency. I think that gold will be a more important reserve asset in the future than fiat currencies. And I think the smart central bankers, particularly some of the creditor nations in the emerging markets, will be taking advantage of the opportunity to buy more gold now that the price have come down. And if some of these European indebted nations like Cyprus or Spain or Portugal or Italy are forced to sell some of their gold, I think it would be very wise for these other central banks to snap it up.
When we see this transfer of gold, where do you think it's going to go?
I think it's going from the west to the east, from the debtors to the creditors, and that's a shift of wealth. And, when you become rich, you can afford to own more gold. When you're broke because you borrowed too much money, you end up giving up your gold. You
think the U.S. is going to have to sell off their gold reserves as well?
Well, I think we're going to need our gold reserves. I hope we don't sell them off. I hope, I'd rather see a restructuring. I think we're going to need all the gold we have, because when the dollar collapses, I think the only way to really restore confidence in the greenback is going to be to back it by gold. And so we're going to need those reserves in order to accomplish that.
Now, crude oil production is up, and with technology and fracking and natural gas, is it possible that this could take us from a trade deficit to a trade surplus? Is the potential for energy independence a mitigating factor in what you consider the real crash?
Well, mitigating factor maybe in that it's better that we develop these resources than that we not have them at all or not develop them. But it's not going to take us from a deficit to a surplus. Eventually, we're going to go to a surplus, but not because we export so much oil, but because we import a lot less of everything else, because the dollar collapses and Americans stop shopping. So eventually, we're going to balance the books. We're going to have a surplus, and we are going to use a lot less energy as a nation because Americans are going to be poorer. I mean, we're already using a lot less energy than we used 10 or 15 years ago because we're poor, because fewer Americans are in the workforce. But that trend is going to continue as, we're priced out of the market. And as people in other countries, other nations whose currencies are going to be gaining in value, they're going to start consuming a lot more energy. We're going to have to supply them with that energy. And it's going to be a good thing that we have it because we're going to need to export it. But it is not a panacea. It's not like, we're not going to have any disruptions in our standard of living, that we're not going to have to dial it down because we've got all this oil. We don't have that much oil. It's better that we can develop the reserves that we have. But believe me, it's not a get-out-of-jail-free card, not even close.
Okay, I want to talk about a piece that you wrote in Investment News that I read titled Lessons Learned from Japan. And one point that you brought up is that on one hand, we criticize the policies of countries that artificially deflate currencies to boost exports, such as in China. But then on the other hand, Christine Lagarde and Ben Bernanke supported Japan's policies of massive easing, which has weakened the yen. So what's okay and what's not okay as it pertains to currency devaluation?
Well, I mean, Japan's policies have been a complete failure. I mean, a lot of people want to point to the mistakes of Japan, particularly here in the U.S., yet we repeat those mistakes. Japan has had this monetary easing policy for, 2 decades now, and it hasn't worked. So now they're just going to increase the size of the quantitative easing. They're printing more money. They're trying to create inflation as if that's how you create economic growth. It's not. I mean, if inflation led to economic growth, then Zimbabwe would have been the growth capital of the world. It's sound money. It's deflation that is more conducive to economic growth. It's when prices go down. That's what happens in a vibrant, growing economy. You produce more, and prices go down, and your standard of living rises. They've got it backwards in Japan. They think if they can just make prices go up, the country will be more prosperous. Well, they're going to get higher prices. You know, sometimes you say, be careful what you wish for because you might just get it. You know, they just had the first price increase in McDonald's
I saw that.
in 5 years in Japan. They raised the price of hamburgers now 20 to 25%. Now, huh?
And Louis Vuitton, too. All your favorites.
Well, Louis Vuitton. Look, now, I suppose that's great news for the Japanese. Maybe for years they were bored. Every time they went to McDonald's, a burger was exactly the same price. Now, because they're going to pay 25% more for the exact same hamburger, somehow this is going to be a boom for the Japanese economy. You know, the crazy thing is they think they're going to create more consumption, more demand by debasing their currency. They're going to destroy demand because they're going to destroy the value of the currency. When prices go up, you buy less. You don't buy more when prices go up. Supply and demand means that as prices go down, that's what stimulates consumption. You demand more of things as the price goes down, not as the price goes up. So they're going to create inflation in Japan, but it's not going to lead to economic growth. If anything, it will lessen economic growth. And so this is going to backfire. And, you know, we should learn that because, you know, we're following in their footsteps, only we're doing it from a much weaker position than Japan. I think Japan, despite all their mistakes, is in better shape than we are, or maybe we're in worse shape than they are. Maybe it's a better way to put it.
The Prime Minister of Japan is devaluing the yen by doubling the monetary base within 2 years. Japan has the highest debt-to-GDP ratio in the world and spends a fourth of all tax revenues on debt obligations. That was Peter Schiff from Euro Pacific Capital.